Okay, let's dive right into an incredible economic mystery, starting with an asset that just did something it almost never does. Welcome to this explainer. Today we're talking about gold. For literally 5,000 years, it has been the ultimate safe haven, right? It's the asset you buy when the world feels like it's falling apart. But recently, right in the face of a massive global crisis, it completely broke the rules. Instead of soaring, it panicked. So, let's find out why.
To set the stage, back in January 2026, gold was the absolute hottest trade on the planet. It shattered the $5,000 an ounce ceiling for the very first time. Central banks were buying it up at a record pace, inflation was absolutely raging, and the precious metal had surged more than 30% in just a single month. Everything was pointing straight up.
Section 1. A record-breaking rally. The peak before the panic.
But the sequence of events is where things get really weird. Fast forward to March 2026, and a massive geopolitical crisis hits. The US and Iran go to war. Iran threatens to close the Strait of Hormuz, which is a huge global choke point where roughly 20% of the world's oil supply flows. This sends crude oil surging above $110 a barrel, and inflation spikes. Now, by all historical metrics, gold should have skyrocketed right here. But it didn't. Instead of flying higher, gold suffers its biggest weekly drop in 15 years, falling roughly 20% to below $4,400 an ounce.
And this perfectly illustrates our paradox. We all universally expect gold to act as this untouchable safe haven during periods of intense geopolitical uncertainty and raging inflation. But reality delivered a completely counterintuitive plunge. It tumbled from $5,400 down to below $4,400 in a matter of weeks. It completely defied what every investor expected.
Section 2. The counterintuitive crash. Solving the mystery.
Section 3. Anatomy of a sell-off. The perfect storm. So here is how this perfect storm actually built up. First, right on the news of the conflict and the threat to the Strait of Hormuz, the US dollar immediately strengthened. Second, this sudden market shock caused leveraged stock, bond, and commodity traders to hit margin calls. Basically, their brokers were calling them up demanding more cash to cover their riskier bets. And third, because these traders desperately needed cash right then and there, they were forced to flood the market by dumping whatever liquid positions they had. And as you know, gold is highly liquid.
There's an old trader adage that perfectly captures the psychology here. You try to sell what you made money on and what is liquid. In a total panic, you don't necessarily sell the assets you want to sell. You sell the assets you can sell. Gold had just surged over 30%. Traders had made great money on it, and it was super easy to offload, so they dumped it to cover those margin calls. Plus, at the exact same time, that stronger US dollar made gold prohibitively expensive for buyers outside the US. So right as all this supply was flooding the market, global demand was essentially killed.
Section 4. The yield problem. The hidden costs of holding gold.
Now, margin calls really only explain the initial shock. The deeper structural issue here is something called negative yield. You see, one of the main issues with physical gold is that it doesn't actually yield anything. It doesn't pay a dividend like a stock, and it doesn't pay interest like a bond. In fact, holding physical gold actually costs you money. You have to pay for secure storage, and you have to pay for insurance. So essentially, gold carries a negative yield. It costs money just to sit there in a vault.
As central banks signaled they were going to hold or raise interest rates to fight off all that inflation, U.S. Treasuries began offering very attractive guaranteed returns. So, put yourself in the shoes of an investor. Why on earth would you hold gold, which pays zero interest and costs money to store, when you can easily earn a guaranteed return from Treasuries? As interest rates rise, gold almost always becomes less attractive. Section 5. Gold's enduring value. Zooming out on 5,000 years. But despite all this modern financial engineering, the core reasons people buy gold haven't really changed much. A massive 90% still goes directly into investment in jewelry. But that remaining 10% slice, that's a rapidly expanding sector of new, high-tech industrial uses. Because of its unique properties, gold is expanding into space exploration, defense tech, medicine, dentistry, and of course, the electronics we use every day. Its real-world utility is only growing.
And think about its role as a store of wealth and its purchasing power. I absolutely love this analogy. A bar of gold could buy a house in the 1950s, and in 2026, it can still buy the average house. Just think about how much the world has changed since the 1950s. Think about inflation and just how much currency has been printed. Yet despite sharp market corrections like the one we saw in March, gold universally maintains its relative value over decades.
Actually, it maintains it over millennia. A coin minted in Belgium roughly 2,000 years ago buys the exact same amount of gold today. It's the ultimate global currency. Everyone across the globe knows how to measure it, everyone knows how to value it, and it's universally accepted to trade or barter with. And I mean, it's survived empires, it's survived world wars, and it has survived every single financial crisis for 5,000 years.
So, the drop we saw in March 2026, that was a dramatic perfect storm of short-term market dynamics, a desperate rush for liquidity, massive margin calls, and shifting interest rates, rather than some fundamental change in gold's long-term outlook. Corrections are common, especially after a huge 30% rally, but it just did something it almost never does. It panicked. So the big question remains, and it's the one I'll leave you with today. Depending on the ever-shifting geopolitical climate and the strength of the US dollar, where does gold go from here? What is the actual next chapter for this 5,000-year-old asset? Thank you so much for joining me on this explainer, and I hope this helped clear up one of the most counterintuitive market moves in recent history.